Yeah, there certainly has been quite a bit of volatility in the Chinese equity markets. And I think one of the things that is probably true is that managers around the world, investors around the world, after rather disappointing returns in the past 2 years, have come to see China as a little bit less investable. And I think part of the reaction that we've seen in the equity markets, part of the volatility that we've seen, is actually because a large number of managers, investors, were actually underweight China versus, say, an emerging market benchmark. And when the catalyst of this stimulus came, there was, it may not have been so much short covering as underweight covering, if you like. And I think that might explain some of the volatility that we've seen. It is the global investor base recalibrating their expectations, and I think to some extent perhaps catching up on a market they had been systemically underweight in at least the first part of 2024.
You know, Tim, it's fascinating though. Shanghai, Shenzhen down almost 10% today. There's a valuation play out there, is there not? It looks like we could see compelling valuations coming through. And on top of that, policymakers have said that more stimulus is on the way. So is this a buying opportunity?
Look, time will tell whether or not it is a buying opportunity. I think the first point that you made, you know, there's a degree of volatility here. When this kind of volatility comes to a market, it does tend to stick around. There may well be a valuation opportunity. It's less cheap than it was a few weeks ago. As I say, time will tell, but one thing that investors should probably be aware of is this kind of volatility, when it comes, tends to stick around for a little while.
Okay, fair point. Let's shift focus over to the United States. One of the other interesting things we've been watching is the 10-year, now back above 4%. I'm curious to get your take on what you think that's going to mean for equity valuations and the fixed income strategy moving forward.
I think when it comes to US equities, there is a very different story in valuations. And there is, of course, a connection between the yield, the rate environment and valuation trends, particularly in growth stocks where you're looking at potentially earnings further into the future. I think the key dynamics in US equity markets to be alert to at the moment are actually the increasing degree of differentiation between different components of the markets. So we measure that with a dispersion, essentially how different are stocks performing, how high or low are their correlations. I think not only do we have a US equity environment that so far this year has seen much higher dispersion, more idiosyncratic risk, more winners and losers. Historically, particularly from a sector and industry perspective, but also individual stocks, elections tend to bring higher industry or sector level dispersion. I think that what that means for investors is, you know, on the one hand, potentially more opportunity to take advantage. On the other hand, more opportunity for embarrassment. But more critically, the opportunity for diversification is perhaps stronger right now than it normally is. We're not in an environment where every part of the market is reacting in the same way to 10-year yields or to the Federal Reserve. There is differentiated responses, and that mix of winners and losers is exactly the point of diversification. It's risk management, essentially, by spreading your bets.